In this tutorial, I'm going to help you better understand your self-assessment tax bill by explaining how the total amount of tax due is calculated and how this is affected by payments on account. What you can see on my screen here is a self-assessment tax return, which is also referred to as a personal tax report. We provide these to our clients for them to review and e-sign before submitting them to HMRC. As this is a demo, a unique tax reference, UTR, has not been entered. A unique tax reference in the UK consists of 10 digits. This number is issued by HMRC to individuals when they register for self-assessment. In this scenario, we will be looking at a self-assessment tax return that has been prepared for the year ended the 5th of April, 2024. I'm going to start by talking through the self-employment details on page 3, as this explains how the profit from self-employment was calculated for the tax calculation, SA 302. I'll then explain the tax calculation, SA 302, on page 1 and finish by reviewing the summary on page 2, which shows the breakdown of payments due to HMRC. In this scenario, the sole trader had a turnover of £35,000 and business expenses of £10,000, which is how the profit from self-employment of £25,000 included in the tax calculation, SA 302, was calculated. Note that tax is levied on profits, not turnover, so even if this sole trader had sales of £100,000, assuming the business expenses were £75,000, the taxable profit would still be the same. As you can see, the tax calculation, SA 302, starts with the profit from self-employment as calculated on page 3. From this we are able to deduct the personal allowance of £12,570, which reduces the income on which tax is due to £12,430. This amount is subject to basic rate tax of 20%, so the income tax charged after allowances and reliefs is £2,486. The total income on which tax is due is also subject to Class 4 national insurance contributions, which some business owners forget to factor in. So 9% of £12,430 is £1,118.70, which when added to the income tax due, results in tax owed for the 2023-24 tax year of £3,604.70. Finally, on the summary page, this tax that you owe figure of £3,064.70 from page 1 is the balancing payment for the 2023-24 tax year, owed alongside two other amounts which are referred to as payments on account. HMRC's first payment on account is an advance payment towards your income tax for the next tax year. It applies if you are self-employed or have other untaxed income and your tax bill is over £1,000. Payments on account are made in two installments, one in January and the other in July. Here's how it works. The first payment on account is due by the 31st of January, the same deadline as your self-assessment tax return. This payment is typically 50% of your previous year's tax bill, excluding student loan payments and capital gains tax. The second payment on account is due by the 31st of July of the same year and is also 50% of your previous year's tax bill. If your actual tax bill for the year turns out to be higher than the payments on account, you'll need to make a balancing payment by the following January. If it's lower, you may receive a refund or have the difference deducted from future payments. It's worth noting that although the payments on account are often referred to as advance payments, the tax is actually still being paid in arrears. So, in this scenario, when the first payment on account is made on the 31st of January, 9 months of the tax year to which it relates has passed, yet it is only intended to be a payment that covers 6 months. Then when the second payment on account is made on the 31st of July, this is nearly 4 months after the tax year to which it relates has ended. As you can see from this scenario, even a modest profit from self-employment of £25,000 results in a substantial tax amount due of £5,407.05 by the 31st of January, So it's critical that the self-employed set aside adequate funds for their tax liabilities from the first month of trading.